Well, good morning and welcome to the bank. You all know Grant. He's the Deputy Governor and Head of Financial Stability. So let me make a few opening comments and then Grant will make some as well. New Zealand's financial system remains sound and the risks facing the system have reduced in the past 6 months. The outlook for the global economy has been improving, but political and policy uncertainty remains elevated and debt burdens are high in many countries. A sharp reversal in risk sentiment could lead to higher funding costs for New Zealand banks and an increase in domestic borrowing costs. New Zealand banks are seeking to reduce their reliance on offshore funding and have raised deposit rates. Dairy prices have recovered in the past 12 months, and most dairy farms are likely to have returned to profitability in the 2016-17 season. However, some farmers are carrying excessive debt burdens and remain vulnerable to a fall in income or an increase in costs. House price growth has slowed in the past 8 months in response to tighter loan-to-value restrictions, a more general tightening in credit, and affordability pressures in parts of the country. Residential building activity has continued to increase, but not enough to meet rapid population growth and the existing housing shortage. House prices remain high relative to income and rents, and any resurgence would be of concern. While the loan-to-value restrictions have increased banks' resilience to any fall in house prices, a significant share of housing loans are being made at high debt-to-income ratios. Such borrowers tend to be more vulnerable to any increase in interest rates or declines in income. The Reserve Bank will soon release a consultation paper proposing the addition of DTI restrictions to our macroprudential toolkit.
Okay, well, the banking system we feel has good capital and liquidity buffers and profitability remains strong. Also, the banking system appears to be operating efficiently compared with other OECD countries based on metrics such as cost to income, non-performing loans and interest rate spreads. Banks have generally tightened credit in light of funding constraints and the increasing risks around housing. They are seeking to limit their reliance on offshore funding and have raised deposit rates in order to try and attract more domestic funding. The Reserve Bank supports a cautious approach to foreign debt in light of lessons learned in the GFC. The Reserve Bank is progressing a number of regulatory initiatives, as well as the debt-to-income consultation paper that we're expecting to put out soon. We're initiating a review of bank capital requirements, and we've released an issues paper to help frame this work. And we recently concluded a review of the outsourcing policy for registered banks, and we and other agencies are currently considering the recommendations of the recent IMF FSAP, the Financial System Assessment Program of the New Zealand system. Thanks.
Well, thanks very much. Happy to take any questions, so please. Alex?
There's quite a few comments in there regarding house prices and Auckland house prices in particular. I think you note a heightened risk of a sharp correction. How worried are you that could happen? And is that based on supply increasing? Or, you know, if the current supply remained the same, would you be less worried about that?
If you look at house price inflation in the last eight months, it's come off very significantly, and we're very pleased about that. So if you take the last 8 months and you annualised it, then house price inflation for the country as a whole has been 2%. If you took the previous 8 months and you annualised that, it would have been 18%. It's the same 18% in that period for Auckland as well, but for the last 8 months annualised, it's been minus 2%. So minus 2% for Auckland, plus 2% for the country as a whole. So that's a very substantial decline. The fact is we don't know if house price inflation will increase again. We're watching it very closely, as you would expect. The factors that can drive it are still there. Very strong migration growth. Interest rates are still low. I mean, mortgage rates have increased 50 basis points, say, since November, if you look at 2-year fixed, but those rates are still pretty low. And so we're sitting in a situation where house price inflation's come off, but the loan-to-value ratios in a place like Auckland are still high. They're close to 9.5 to 10. And 5 years ago, Auckland was 6.5. And you've seen the increase in share of lending to borrowers with high debt-to-income ratios. We've covered that in the financial stability report. So you've seen that ratio increase over the last 3 years for first-home buyers and other owner-occupiers. Increased for 2 of the last 3 years with investors, but it's come off with the investor category because of the loan-to-value restrictions that we introduced. So yes, we are still concerned and watching it very closely.
But Alex, are you concerned? Is your question about the risk of a faster downturn? Yeah, I mean, I think that risk is there, but the longer you see a moderate, flattening of the market, that risk reduces. So I wouldn't say it's increasing. I mean, if it was going up into a spike, then that would increase the risk of a sharper correction. Also, I don't think on the supply side, buildings at a strong level, but it's sort of softened a little bit. So you haven't got a situation of massive building of apartments that could run the greater risk of like a repeat of what happened in Brisbane and Melbourne with some of the apartments with an overhang being created. So that risk is there, as long as the stretch is there, but we don't think there's sort of an imminent risk of collapse.
Karen?
The government in the budget was forecasting immigration to be around 200,000 over the next 4 years, 212,000, but obviously opposition parties are proposing quite big cuts in immigration in tens of thousands, 50,000. Have you looked at what impact a big drop-off in migration would have on those, on the house prices and on the impact on, particularly in Auckland?
Well, I mean, only in broad terms. I don't think it's possible to have a sort of a mathematical model of link from the prices to migration. But clearly, the two key drivers of the housing market the net migration and interest rates. And if the migration flows come off, particularly if they came off sharply, then that clearly would present some risk of leaving, dropping demand and leaving an overhang which could cause a sharper price correction. But, even if there is policy changes later in the year, I think it'd be unlikely to see a very sharp correction, like the gate suddenly being shut. Policy changes normally take a while to have effect.
Hi, Anna DaCosta from Reuters. I'm just wondering what needs to happen in the housing market for you to decide to, when these DTI restrictions become available for you to decide to actually implement them. Thank you.
Well, I think, we've been pretty clear that we would want to see debt-to-income ratios as a macroprudential tool in terms of the toolkit available to the bank. But we've also been pretty clear over the past several months that we wouldn't use them if we had them at this point in time. So if we were in a situation where we saw house price inflation start to pick up again, and we also had debt-to-income ratios starting to increase again like they have over the past 3 years. So if they continued to rise or even remained at high levels while house price inflation was resurgent again, then they're the sorts of things that we would look at very closely.
On the issue of mortgage stress for homeowners, in the letter I think you sent to the government last year or in January, you raised some concerns about whether the retail banks were properly assessing customers as to their ability to meet their servicing costs and their extra expenses. How worried are you that banks aren't doing the proper checks in terms of before they're issuing loans?
Well, I think, they do have checks. They have checks on debt service as well as LVR. And, it's always the extent to which we want to sort of reinforce some of those disciplines. And sometimes that arises because we're looking at bigger systemic effects and feedback effects that the individual banks don't necessarily look at. But yeah, they do look at buffers, and particularly will run a debt service test, with say another 2% on interest rates over and above what they're going to pay. But the risk, there's risk, of course, that shocks could be greater than that, and the interaction of some of these shocks can also cause potentially greater trauma in the market. So I guess we just have a different perspective of being more of a systemic perspective relative to the individual banks.
But you don't want them to change their practices, or do they need to tighten them up? That's always something to look at. I mean, in a sense, we're saying if we had a DTI instrument, in the toolkit but wasn't being used, then that's effectively saying, no, we're happy with that level of discipline that's there. If we feel as the pressure comes on and the risks are getting greater, if that market started taking off again, then we'd be looking to tighten up those standards. You can either do that through a macro-prudential tool or tighten up sort of micro-prudential tools. And if we feel it's a temporary thing, a cyclical thing, then the macro-prudential sort of channel might be the best approach.
You've mentioned in the FSR that the banks have closed the gap between lending growth and term deposit growth a bit, but that there's still been an increase in the amount of overseas funding they're having to use. Mm-hmm. Would you like to see the banks further close that gap by, competing harder for local term deposits? Are they doing enough, or would you like to see them do more?
Well, that's a judgment that the banks have to make in terms of their own funding criteria and their exposures that they want to take in terms of their treasury management. But I think it's helpful that if you've got a situation where your lending growth is exceeding that of your funding growth, or at least your deposit growth, then you either have some basic choices to make. You can cut back your lending growth in terms of your lending criteria. You can go to offshore financial markets and borrow on the wholesale markets, or you can compete more aggressively on the domestic market. Now, that's a judgment for them about their foreign currency exposure and their swap market activity. But in essence, we're very happy at this point to see that banks are increasingly trying to source their financing on the domestic market.
And just on the capital review that's ongoing, what would you expect that to do to lending standards, appetites for lending growth, and ultimately financial stability over the next couple of years? Because in theory, if you're going to ask them to hold more capital, they'll be less keen to lend more and have to improve their margins and try to get a better return on that capital.
Well, I'm not sure there's necessarily a close relationship between capital ratios or capital requirements and lending growth. There's a lot of other factors involved there. But clearly, a conservative approach with capital adequacy will improve the resilience of the banking system to any shocks that come along. So, it's the basic buffer against insolvency that's in the system. It's really the central prudential tool that we have. So the review is looking to, ensure that we have a conservative approach and that we're conservative relative to peers. And also we want a simple regime as possible. We want to avoid unnecessary complexity. And unfortunately, there is a fair bit of complexity that comes through the international regime through Basel. And so we have to find this balance compared to what comes through Basel and what's sensible for the New Zealand system.
You changed your view on Kiwibank's Tier 1 issue. Are there any others where you think you might need to look again at whether they've got it right?
We don't want to comment on particular institutions or particular issues, but I would say that the issue that we've been dealing with Kiwibank is specific to Kiwibank and doesn't necessarily have any implications for other banks or other convertible instruments.
Hi. I think back in March, you called the US administration's America First policy as one of the greatest sources of uncertainty. I was just wondering if that's changed at all, and if so, how?
No, I think there's still a great deal of uncertainty about where the US might go on trade policy. It looks as if they are seeking to renegotiate NAFTA. We know what's happened with TPP. Looks as if they've reached a deal with the Canadians on lumber exports. Looks as if they're working on a deal with China around steel. There's a 100-day review period where there'll be further discussions. So a lot of uncertainty around trade policy. There's been no call for China to be no mention that China's a currency manipulator or things like that, which is helpful language. I think that's been avoided. Then, if you look on tax policy, I think there's a lot of uncertainty about what the outcome will be. And then, if you look at the budget submission that was submitted to Congress, I mean, there's basically very large cuts in government agencies, including something like a 30% cut in the EPA, 27% cut in the State Department, and an increase in defence spending. Now, what chance has that got of going through Congress is there's a lot of speculation that there's very little chance. So I think there's still a lot of uncertainty around the US administration and trade and fiscal policy, particularly tax policy. A lot of uncertainty about where health reform will go in the Senate. But it's not just the US. There's issues around China and the debt situation. There's issues around North Korea, as we know, and around the Middle East, Syria. A lot of uncertainty around oil prices. Whether OPEC will be able to hold the cuts, production cuts, things like that.
Governor, you've mentioned in here that the housing supply is not keeping up with population growth. How much of a factor in the supply restriction is the potential for higher capital requirements, the banks tightening their lending standards, the need to try and match their term deposit and lending growth? How much of a factor in that supply response is what the banks are doing and their responses to regulatory changes both here and elsewhere?
Well, the banks are affecting the demand for housing at the moment, in the sense that they've got higher funding costs that we talked about, that they're passing those on, and you're seeing an increase in mortgage rates. You've seen them tighten up in their lending criteria, particularly to highly leveraged borrowers more recently, particularly over the last 6 months or so. And then you've seen them tighten up their lending to developers. And I think the concern that they have in some respects around developers has been the productivity or the bottlenecks that are occurring. Let me put it that way, the bottlenecks that are occurring in the construction sector. You see construction inflation now at around 8% in Auckland and about 7% nationally. But the information that we've got at this point in time is that, well-considered proposals from developers are still being financed by banks. They're just looking more carefully at them.
Yeah, so I think, just to follow up, there's some other factors that we think may have, been slowing the growth of residential consent. So one of them is just the sort of shift of resources from Canterbury, where Canterbury is sort of coming off the building boom there, and that sort of relocation of resources is a factor. Potentially also the Kaikoura earthquake and a lot of resources for maintenance, particularly in commercial sites in Wellington. And the other one was the unitary plan, where the changes was taking time for the unitary plan to become in Auckland to be finalised, and so that some people were sort of holding fire on projects.
If you look at consents nationally, they're running at around 30,000, and Auckland are roughly around 10,000. And both of those figures are 12-year highs. But the truth is that just not enough houses are being built for many of the reasons that we talk about in the report and in previous press conferences.
It's annoying, you just have to keep saying that? Sorry. You've been saying that since I've started reporting on the Reserve Bank, like 10 years ago. Does it get annoying?
Well, we have to deal with the housing imbalances and the risk that it poses for financial system stability. So we're always going to take a huge interest in the housing market. And if you look at our banks' lending books, basically housing accounts for roughly 55% of their asset portfolios. So we're always going to be heavily interested, and there are various frustrations around the supply response that we continue to talk about.
Just on the issue of debt-to-income ratios, on the income side of things, do you have any concerns about wage growth at the moment, that that's still too sluggish and not sort of, would you like to see it increasing faster to try to level up the balance a little bit?
Well, if you look at wage growth, it's been a puzzle in many economies about why is it why has it been so weak? And, you can sort of speculate that, what those various reasons might be. It could be related to expectations of wage outcomes being reflected or influenced by past low rates of inflation, for example. So in other words, expectations become backward-looking, low inflation, low expectations going forward. It could be linked to periods of unemployment in the past or risk aversion around that, or it could be linked to the composition of employment in terms of, service sector employment, some of it being in low wage, low productivity areas. If you look at productivity, it's been very low by and large across most of the advanced economies. And you're seeing a service sector, which, the service sector is the main employment engine in most of the advanced economies. You're seeing that service sector become increasingly globalised. So a lot of those services are traded, and there's a lot of international competition for those services, and that's been depressing wage growth. So it's been a puzzle in New Zealand to some degree, and it has been across many advanced economies. You've got a situation in several advanced economies in this recovery where you've seen relatively weak business investment growth, relatively weak labour productivity growth, and relatively weak wage growth, but quite strong employment growth.
The DTIs, you've mentioned box A, I think it is, and you focused on the level of 5 times income as an area where those people are more vulnerable if there was stress. Is that level of 5 something that could potentially be a threshold for any sort of DTI limit that you might look at, including in the kit?
That's possible, but nothing's been determined. And, when we put it in the kit, if we're allowed to put it in the kit, it wouldn't necessarily have a specific threshold attached to it. Just as LVRs are in the toolkit, but they don't have any particular thresholds identified. Those are the policy decisions that have to be made in any given set of circumstances. But 5 is, we think, if we get over 5, that's pretty high, and it tends to be the area where, potential stresses are going to emerge if there's a shock to interest rates or incomes.
If we did introduce something at some stage, then it would probably have a speed limit aspect to it, just like the LVRs. So if you look, for example, at the UK, I think they've got a ratio of 4.5 where new lending for owner-occupied housing is, you're allowed 15% above that 4.5 DTI. So that concept of a speed limit is probably something that we would look closely at.
And I notice in the stress test box that you've looked at owner-occupiers. Have you also done a stress test on rental property investors, particularly in Auckland, if we get to that 9% interest rate?
Bernard, have you got an answer to that?
Not specifically, no. I mean, that particular box is looking at the borrowers coming out of the household expenditure survey, which is largely focused on owner-occupiers.
Because in theory, because they have higher debt-to-income multiples and are more likely to use interest-only lending, they would be even more vulnerable in the event of a big increase in interest rates, particularly in Auckland.
Yes.
But
That's right. So, the investors have the larger DTI ratios. So you're right. That's the potential area of stress for sure.
Would that mean, therefore, you'd be likely to or potentially include in the DTI policy something that targeted investors because they're riskier than owner-occupiers?
I wouldn't say so. I mean, of course, the LVRs that we put in last October are investor-focused, residential investor-focused. So actually, because investors tend to have high DTIs, I mean, you see in some of the charts in here that the restraint on investor credit has actually reduced the overall DTIs because the risky lending tends to, will tend to be high on both counts.
Still over 50% though for investors above that 5 level.
Yeah.
I just wondered if you could give us a little bit more detail on what soon means in terms of when this consultation paper might be ready. Are we talking weeks, months?
The paper's over with the Minister of Finance at present, and the arrangements that normally apply are that the Minister has a couple of weeks to look at the paper and express any views. I think it likely, I suspect, that the paper would be released within the next couple of weeks.
You mentioned the IMF report and that you were looking at the their assessment. They had some views on deposit insurance. Is the Reserve Bank having another look at this at all, or are you pretty set in your view?
We're comfortable with our view on deposit insurance. Did you want to add anything, Grant?
Well, the thing they also mentioned in the report was that potentially looking at a clearer or clarification of what's called the de minimis policy, which is a small assured amount or preference for depositors that they will get back, X thousand dollars in the case of a bank failure, and would take preference, and that those claims would take preference. So the IMF said, well, their preferred prescription is deposit insurance, but if you're not going to have that, then you should maybe clarify the de minimis policy.
And what's your view on that?
Well, we think that probably makes sense, and we're looking at that closely and talking to government and Treasury about potentially clarifying the de minimis.
Do you have a view? They've suggested, I think, off the top of my head, 150,000 or 100,000.
No. I think they talked about 10,000, didn't they? Yeah.
Okay. And are you
up to 10,000?
Up to 10,000. So, what sort of time frame are you looking at for that sort of clarification?
I would hesitate to put a time frame on that.
Thank you.
How much of an issue do you see with construction capacity constraints on New Zealand's economic growth?
Yeah, it's you're certainly seeing bottlenecks appearing there. I mean, if you look at building permits, as I just mentioned, they're running at 12-year highs. If you look at the total construction investment as a share of potential output in the economy, you're getting close to the sorts of peaks that were there in 2006, 2007 or thereabouts. And you are starting to see the inflation pressures coming through as a result. Now, migration has been a source of labour for that sector, and as Grant said, that sector's also transitioning from the end of the completion of work in Christchurch in many respects, certainly on the residential side, and the movement of those resources to Auckland. But you are starting to see bottlenecks there and some increase in wage growth, but particularly in margins. So that's something that we're looking at pretty carefully as well. Well, thanks very much indeed.